A $50,000 car can quietly cost you $68,493, and the ugly part is, you'd never see it coming from the sticker price. That gap isn't fees or dealer markup. It's tax, created the moment you pull that cash from the wrong account. And here's what should calm you down before we go further. Your mortgage rate doesn't move, your investments don't get sold at the wrong moment, and your emergency reserve doesn't have to disappear to make this work. The mechanism that closes that gap is something most retirees never hear their bank or their tax preparer mention out loud, and I'm going to walk you through the exact math using a realistic car price, a realistic account balance, and a realistic tax bracket, so you can see precisely where the extra $18,000 comes from and how to keep it in your pocket. There are two things I want you to sit with before we get into numbers. First, if you retire and quietly assume that paying cash for a car is always the responsible move, that assumption can fail you the exact moment you actually pull the money. Second, there's a hybrid approach near the end of this that lets you buy the car, protect your liquidity, and keep your tax bill boring, all at the same time, without turning a car payment into some multi-year financial burden you didn't need. Both of those ideas are coming. Stay with me. Quick disclaimer, because I'd rather say it once than bury it in fine print. The numbers I'm using are clean, round examples built to show you how the mechanism works. Your real tax bracket, your state, your account mix, and your actual reserve are going to shift the exact dollar amounts. The logic, though, doesn't change. If any of this sounds like your situation, it's worth doing the same napkin math with your own numbers before you write a check. If you've found this useful so far, stick around, because the second half is where the real decision gets made. This matters most if you're retired or near retirement. You've got real money sitting somewhere, but most of it isn't sitting in a checking account. Maybe it's in a traditional IRA from decades of 401k rollovers. Maybe it's home equity. Maybe it's a taxable brokerage account that's grown for 20 years and comes with its own capital gains complications. You need a car because yours is aging out or something just failed, and your instinct, the responsible instinct, is to avoid debt entirely and just pay cash. You don't want a monthly obligation in retirement. You don't want interest eating into a fixed income. That instinct is not wrong, but depending on where that cash actually comes from, paying cash and paying nothing extra can turn out to be two very different promises. Under the assumptions I'm about to walk through, the gap between those two outcomes runs into the thousands, and it's worth 90 seconds of your attention to see exactly why. Let's put real numbers on it. Picture a retired couple, $68,000 in age, not too far apart, with $80,000 sitting in accounts they can access. They've decided $50,000 of a self-imposed emergency cushion is the number they never want to go below, no matter what. They need a $50,000 vehicle, out the door, no trade-in, complicating the math. The obvious move is simple. Write a check for $50,000, drive home, done. No loan, no interest, no lender. Now move forward to the moment they actually go to pull that money. If it comes straight out of a savings or money market account that's already been taxed, this is genuinely clean. They spend $50,000, they're left with $30,000, and that's the whole story. But for a lot of retirees, the bulk of their accessible money isn't sitting in savings. It's sitting in a traditional IRA, funded for decades, with pre-tax contributions that have never been taxed. Here's where it gets interesting. If that $50,000 comes out of a traditional IRA, the IRS treats every dollar of it as ordinary income the moment it lands in the account. That's not a penalty, and it's not a surprise buried in fine print. It's how traditional IRA withdrawals have always worked. But it means the $50,000 you want in your pocket is not the $50,000 you need to withdraw. You expected to write a check for $50,000 and be done. Instead, using a representative combined federal and state rate of 27%, you'd need to withdraw roughly $68,493 from that IRA just to net $50,000 after tax. That's an estimated tax bill of about $18,493 on a car that costs $50,000. The car didn't get more expensive. Your access to the money did. This is the part that trips people up. Lowering your account balance and lowering your actual cost are two completely different things. Paying cash reduces your balance by whatever you withdraw. It does nothing to reduce the tax bill triggered by where that cash came from. You solved the "I don't want a loan" problem. You didn't necessarily solve the "I don't want to overpay for this car" problem. And those are not the same goal, even though they feel identical in the moment. So why not just skip the IRA and pull the $50,000 straight from savings instead? For a lot of people, that's genuinely the right answer. And if your savings comfortably covers it without touching your safety floor, you should probably just do that. But remember the other version of this couple, the one with $80,000 total and a $50,000 reserve line they don't want to cross. Pulling $50,000 straight from savings leaves them with $30,000, $20,000 below their own floor. They've avoided the tax problem and created a liquidity problem instead. Either path, cash from savings or cash from a pre-tax account, can quietly cost you something you didn't plan to give up. This is where a short, boring, fixed-rate loan becomes worth a second look, not because debt is virtuous, but because it lets you separate two decisions that don't need to happen at the same moment: buying the car and deciding how and when to convert your retirement savings into spendable cash. Here's the mechanism. Instead of draining an account or triggering a big taxable withdrawal, you put down a modest amount from cash you already have after tax and finance the rest through a short, fixed-rate auto loan, ideally 3 years or less, secured through your bank or credit union rather than the dealer's in-house financing, which is frequently marked up over the actual buy rate. What stays the same? You still own the car outright once it's paid off, and your net worth is essentially unaffected either way, since a loan is simply a liability against an asset you now hold. What changes is the timing and the tax exposure. You're no longer forced to convert $50,000 of tax-deferred savings into taxable income in a single calendar year just because a car needed replacing. Let's run the actual comparison. Using the same $50,000 car, put down $10,000 from cash on hand and finance the remaining $40,000 over 36 months at 6%. Your payment lands around $1,217 a month. Over the life of the loan, you'll pay back roughly $43,800, which means total interest of about $3,800. Compare that to the IRA scenario. Paying cash from a traditional IRA cost you an estimated $18,493 in tax. Once, immediately, whether or not you could really afford to lose that money that year. The loan costs you about $3,800 in interest, spread across 3 years, in exchange for keeping $40,000 of your money liquid, untaxed, and sitting exactly where you can still reach it if something else comes up. That's the headline number, an estimated $14,000 difference between the two paths, before you even count what that $40,000 is worth just sitting there as a cushion. To be precise about what that interest figure actually represents, it's the total finance cost at a 6% fixed annual percentage rate over 36 months on $40,000 financed, before considering any return that money might otherwise earn, and before your personal tax situation is factored in. Your real number depends on your credit, your lender, and current rates. Let's be clear about what this loan is not. It is not a way to avoid ever paying tax on that IRA money. You'll eventually withdraw it, and it'll eventually be taxed, either through required minimum distributions or when you actually need to spend it. It is not free money, and $3,800 in interest is a real cost, not a rounding error. And it's not automatically the right call for every retiree in every situation. What it is a tool for controlling when a taxable event happens, instead of letting a car breakdown decide that for you. Before you'd act on any of this, a few things matter. First, rate shopping matters more than almost anything else here. A credit union or your own bank will often beat a dealer's marked up in-house rate by a meaningful margin, sometimes 1 to 2 full percentage points, so get pre-approved before you're standing on a dealer lot with less leverage. Second, keep the term short. Stretching a loan to 60 or 72 months lowers the monthly payment but usually increases total interest paid and keeps you owing money on a depreciating vehicle for longer than makes sense. Third, check for a prepayment penalty before you sign anything. Most auto loans don't carry one, but your state and your specific contract control that, not a general rule, so read the payoff terms directly. Fourth, this only helps if the alternative really would have triggered a large taxable withdrawal or drained your reserve below a level you're comfortable with. If your accessible cash is already sitting in an after-tax account, sitting well above your reserve floor, financing doesn't buy you much, and paying cash directly is simpler and cheaper. Now, the conventional case for just paying cash entirely still deserves real credit, because it does eliminate one thing completely: monthly obligation risk. No payment means nothing to miss if your income changes. no interest accruing on a shrinking balance, and no paperwork with a lender at all. If you're pulling from an account that's already taxed, and your reserve stays comfortably intact afterward, cash is genuinely the cleanest option available, and there's no hidden trap waiting on the other side of it. Set the two paths next to each other, and the shape becomes obvious. Cash from an already taxed account. No interest, no loan, but only clean if your reserve survives it. Cash from a pre-tax account, no loan, but a real and immediate tax bill that can run into the thousands depending on your bracket. A short fixed loan, a modest, known interest cost in exchange for keeping your reserve intact and your tax bill exactly where it already was this year. Same car, 3 different costs, depending entirely on where the money would have come from and what you'd be walking away from to get it. Which brings us to the actual decision, because what you're weighing isn't debt against no debt. It's a known small contractual interest cost against an unpredictable tax or liquidity cost that shows up depending entirely on which account you'd have rated. A 3-year loan at a competitive rate is not a trap. It's a way of keeping your options open, while a much bigger, more important pool of money keeps doing its job undisturbed. Think about it this way. In an ordinary month, none of this matters much either way. The payment gets made, the car runs, life continues. But picture a different month. A roof leaks, a medical bill shows up, or the market drops 15% right after you retired. If you'd paid cash from your IRA, you already gave up $18,000 to taxes you didn't have to trigger yet, and that money is simply gone. If you drained your savings below your own floor, you're now facing that new expense with less cushion than you told yourself you'd keep. But if you financed a modest loan and kept your reserve intact, that emergency gets absorbed by cash you still have, not by a decision you already made and can't undo. That gives you 3 real doors, not one right answer. Door 1. Pay cash from an account that's already been taxed, as long as your reserve comfortably survives it. This is simplest and cheapest when it applies cleanly. Door 2. Pay cash from a pre-tax account like a traditional IRA, accepting the tax bill as the price of zero debt, which can make sense if you have no other option and genuinely don't want any loan at any cost. Door 3. Make a modest down payment and finance the rest on a short, competitively priced loan, preserving both your reserve and this year's tax picture in exchange for a known, limited interest cost. None of these is universally correct. The right door depends on where your money actually sits, what your reserve looks like today, your comfort with any monthly payment at all, and how much you value having cash available if something goes wrong next year instead of this one. Now, who should skip the loan entirely and just pay cash outright? If your accessible money is already sitting in a taxable savings or brokerage account, if paying cash doesn't put you anywhere near your reserve floor, and if you genuinely dislike having any monthly obligation, there's no real reason to introduce a loan here. You're not missing out on some secret advantage. You're just choosing the simpler tool because the tax and liquidity problems this loan solves don't apply to you in the first place. Likewise, if you're already carrying higher interest debt somewhere else, a credit card, a personal loan, that debt should usually get paid down before you take on anything new, regardless of how attractive the auto rate looks. And one honest caveat on the loan side: $3,800 in interest is a real cost, not a hidden win. You're trading a known, smaller cost for flexibility and tax control, not discovering free money. If the $40,000 you keep liquid just sits idle earning very little, some of that flexibility argument weakens, though the tax timing benefit and the reserve protection generally still hold on their own. This is a trade, not a trick, and it only makes sense if you actually value what you're getting in return. So here's the whole shape of it, one more time. Paying cash lowers your balance, but it does nothing to lower the tax bill that shows up depending on which account that cash comes from. Pulling $50,000 from a traditional IRA can mean withdrawing closer to $68,000 once you account for tax, an estimated $18,000 difference on paper. Pulling it from savings avoids that tax, but can quietly break your own reserve floor instead. A short, competitively priced loan costs roughly $3,800 in interest and, in exchange, keeps $40,000 liquid, keeps this year's tax bill unchanged, and keeps your reserve exactly where you set it. So, which door would you actually choose? Cash from savings, cash from the IRA, or the loan that keeps your reserve intact? Tell me which one, and more importantly, tell me why, because the reasoning behind it matters a lot more than the label on the door. If this helped you see a decision you hadn't fully priced out yet, It's worth passing along to another retiree who's about to write a check without checking where that money's really coming from.